Hi there guys, MS Gojo Mentors and we back again. So guys, in this video we're gonna be giving you guys the whole day trading course completely for free. So we really appreciate it if you hit the like button, share the video and make sure you subscribe. For those who are new to the channel guys, we've already been giving away our course completely for free. You can check out the videos that we already posted about our course. Currently guys, in this specific video we'll be teaching you guys about the trading sessions, everything you need to know about trading times, when to trade and when not to trade. This video is important for you as a day trader. You have to make sure you watch this video up until the end. So yes guys, without any further waste of time, let's jump into the lesson.
We are facing a big problem of scammers, guys. There's a lot of scammers impersonating FS Goals and people actually believing that it's us. And this has been a big problem because we've been actually trying to solve it for the past 3 years. Make sure that you follow me on Instagram, guys, at tapelo_goat. That's how my account looks, guys. Anything else besides this is actually a scam. And also make sure that you follow my twin, IMS_no_limits_. And lastly, make sure you follow FS Goals and follow everyone that FS Goals follows. Let's start with the lesson. Forex market structure approach. This is one of the most biggest lesson regarding forex trading, guys, because how you're going to actually approach trading on a day-to-day basis. A lot of people have now learned trading, but they don't know on how to integrate it with their day-to-day duties. Okay, before we start with forex trading approach, guys, I need to explain to you guys the importance of having a forex trading strategy, guys. If you don't have a forex trading strategy, guys, you won't be able to have an edge over the market. A forex trading strategy is a system that a forex trader uses to determine when to buy or sell, together with technical and fundamental analysis for building confidence when executing trades. Basically, guys, what this means, like I said before, guys, a strategy will help you determine basically when to buy and when to sell. As long as you are able to identify how to buy and how to sell, you basically have a strategy. So let's continue with the lesson, guys. Components of being a professional trader. These are the components that you will require in order for you to become a professional trader. This is literally the only two things that you will need in order for you to become a professional trader. For us to even dedicate time to create our lessons is actually because we do understand what it means and how it feels to be on the other side. We've actually been that side before and we really know how difficult it could be. Hence, we're actually doing these videos, guys. It will also mean a lot for you to actually put in a lot of effort to become successful, guys. There is literally nothing that can stop you from becoming successful. Let's continue with the lesson. So, you need a trading plan or weekly structure approach. Firstly, I'm going to start with you need to know trading hours, guys. A lot of people don't know when and when not to trade, because after making their wins, they tend to give them back to the market because they don't know when not to trade after basically getting their wins. Let's continue. Forex trading hours. Market open and market close intervals, guys. The forex market is open 24 hours a day in different parts of the world. This ability of the forex market tradable over a 24-hour period is due to having different parts of international time zones. Basically, guys, what it means that the reason the market is able to be traded 24 hours is because we have different types of time zones like Sydney session, Tokyo Asian session, London session, and New York session, guys. Basically, all the sessions are creating 24-hour different time zones. Okay, the actual tradable times for retail traders is 24/5, 5 days per week, guys. Synthetics are traded 24/7, which is your VIX, your boom, etc., guys. But when it comes to forex trading, which is your currencies, your indices, we only trade them 24/5. The market opening time is every Sunday, 12 a.m. GMT +2. As you can see, guys, our time zone is South Africa. In the US, it's just only GMT, meaning that yours will be subtracting these two. Our 12 a.m. for you guys, it will actually be 10 p.m. All right. Make sure you go to Google and Google your country's time zone to understand this lesson, guys. All right. Let's continue with the lesson. The market opening time is every Sunday, 12 a.m. GMT +2 with the open of Sydney session. And the market closing time on Friday is at 12 a.m. GMT +2 with the closing of the New York session. Secondly, we're going to now talk about trading sessions, guys. This is when now you need to know when and when not to trade, guys. This is the most biggest lesson, guys. Make sure you actually pay attention on this specific chapter right here. All right, let's continue with the lesson, guys. The forex market can be broken up into 4 major trading sessions: the Sydney session, the Tokyo or Asian session, the London session, and lastly, Trump's favorite time to tweet before he was banned, of course. I'm joking, guys. The New York session. So basically, we have 4 types of session: the Sydney, the Asian, the London, and the New York session. So the first question you need to ask yourself, guys, is how many sessions are tradable and how many sessions are not, and which sessions do you trade and which ones do you not trade. All right, for you to understand this, let's continue with the lesson. You need to verify each session's time zone of your country to know when they occur, exactly like I said before, guys. For example, in SA, if we check the Sydney session time zone, it won't be the same if you're from US. However, because I'm from South Africa, I'll be explaining to you guys from a South African time zone. All right, so let's continue with the lesson, guys. For example, the best time to trade Forex in South Africa is generally between 9 a.m. and 4 p.m. Why? Because, guys, these tradable sessions are London and New York session, guys. A lot of people are able to make money, but they'll always give it back to the market because they also trade when it's not time to trade, guys. You don't trade 24/7 every time, guys. By the end of this lesson, you will definitely know how to approach trading on a day-to-day basis and still be able to live your life or even still have a part-time on the side. Let's continue, guys. These two sessions account for more than 50% of all Forex trades, guys. Exactly. These are the most important sessions, guys. If you are trading Forex and if you are serious about being a Forex trader, you need to make sure you know your London and your New York session, guys. These are the sessions whereby the market actually moves. These are the sessions whereby each trader should actually focus on when they really want to know how to make money regarding Forex trading. All right, Forex sessions or trading hours. Now that you know we have different types of sessions, so you basically would now need to know which type of sessions we trade and at what time. Exactly what I just spoke about, guys, on the previous slide. Non-tradable hours, guys. There's a lot of people who are trading non-tradable hours, and hence they get to actually lose their money back to the market, because after making their money on tradable sessions, they get to now trade on non-tradable sessions, of which they will now obviously lose their money. So the first session, which is non-tradable, guys, the Sydney session, and secondly the Asian session. As you see, guys, in South Africa, our time zone GMT plus 2, our Sydney session is from 12 o'clock all the way to 2 a.m. and our Asian session starts from 3 a.m. all the way to 8 a.m. in the morning. All right, in these times we are not trading. In these times I am sleeping, guys. Tradable hours. In tradable hours, guys, we are focusing on the London session and the New York session, guys. And from just these two sessions, guys, you'll get to see how important they are for you to know sessions and knowing when to trade and when not to trade. All right, so the London session occurs from around 9 a.m. all the way through to 11 p.m. This is the first time you should be looking for your first trades in the morning, guys. If you are trading currencies and you want to trade, I would suggest that you wake up around 8, analyze for an hour or even 30 minutes. Make sure you have your trading structure, your trading plan. And for those who are Nasdaq traders, you can start actually coming closer to the market around 9, because the Nasdaq market open starts at 9:30 GMT plus 2. So for Nasdaq traders, we open at 9:30, and for currency traders, we open at 9. All right. The London session is strong, guys, but it's still not the most volatile. My favorite session, guys, which is most volatile, is the New York session, guys. Every trader who is a successful trader will tell you about how volatile this session is. So basically, guys, a professional trader trades only 2 to 3 times a day on London and New York sessions only, guys. As a professional trader, you need to have some sort of a timetable, some sort of a time structure. For example, guys, let me show you on how I trade my Nasdaq. For instance, this would be my alarm system. This is exactly when and only when I look at the market, guys. As a trader, it doesn't mean that you are tied to always be glued on the screen, guys. As a trader, you must know when to trade and when not to trade, so that you are able to not become a chat zombie. Because a big problem we're facing right now is that, guys, a lot of new traders are treating Forex trading as if it's not a business, especially those who come in trading Nasdaq, guys. I would say for anybody who wants to approach trading Nasdaq, guys, trade Nasdaq, provided that you also started with currencies. I mean, even us being your mentors, we didn't start by trading Nasdaq. We started trading currencies first. Currencies can actually build a strong foundation, guys. You need to make sure that you don't sleep on foundation. Like, for instance, knowing your sessions. Nasdaq is for the professionals, guys, because a lot of people don't know on how to take losses, guys. All right, last topic for the day, guys, I will be explaining Forex trading plan and approach. What is a Forex trading plan? A trading plan is an organized approach to executing a trading system that you have developed based on the market analysis and outlook, while focusing on risk management and personal trading psychology. A trading plan is when you are basically having a system, guys. A trading plan is created to strictly reduce the number of bad trades. Why? Because when you have a plan, you actually have an edge over the market, guys. Anything that is unplanned, you'll have unplanned results. But if you have planned trades, you'll have planned results. All right. It's very crucial for every trader to actually know on how to set up the trading plan. But luckily for you guys, we are here. FS Goat, your mentor. Yes, sir. Here are the 4 things that every plan should include, guys. These are the most important things you need to have, especially on how you're going to approach how to make a trading plan. All right. So firstly, skill assessment. What do we mean? Are you ready to trade? Before you even start trading Forex, do you know how to trade? If you don't know how to trade, then what are you doing? You need to first learn before you earn. If you invest into something you don't have any knowledge of, you are actually going to lose money. So it's very important that you actually make sure you understand trading. Secondly, set your risk level. How much are you risking on one trade, guys? You have to understand how big is your account size. What is your proper risk management ratio? And if you still don't understand proper risk management ratio, then you need to do a lot of work, guys. We like to say keep a lot size from 0.01 to 0.05. As long as you want to have realistic goals, these are actually targets, guys. For instance, if you want to say you want to make money this week and you have $100 account, your first target for the week would be to double the account. As long as you're trying to double it in a day, you can lose it in a day. But as long as you do it weekly and proper risk management, overall, guys, every strategy will always have an edge over the market. You can take losses, but it doesn't mean losses can blow your account. Hence, you apply proper risk management and realistic goals, and you know how to trade. Lastly, trade preparation, guys. Set your entry and exit point. It's important to know where you entered and where you exit your trade. Hopefully you guys enjoyed this lesson. This is the first of many to come. Without any further waste of time, guys, FS Goat, your mentor, signing out.
Hello everyone, this is FS Goat, your mentor. I'm going to be showing you the day trading strategy for currencies. Now, this lesson will include sessions and the rule that revolves around them so you can find your way to profitability. All right, so let's get started. All right, now in the market, there is a fundamental weekly market cycle. Now, in my experience as a trader, I've noticed a cycle comes into play almost every week. This cycle will usually take place on the 15-minute time frame. Now, guys, weekly market cycle is structured around trend establishment. Now, what do I mean by that? By finding your entry and exit points, this is how the trend is going to be established. We'll explain that later. Now, we have 3 major trading sessions. We have namely the Asian session, the London session, and the New York session. These are the 3 major sessions that play a major role in our day-to-day trading. Now, there's a certain process that the market has to go through before you as a trader starts thinking about taking any positions at all in the market. Meaning there are certain things that the market has to do before we decide to trade. All right. For example, the market needs to establish a higher low of the day. Only then will we be looking to take a position in the market. Obviously, this will only apply in the proper context of the market. It is from these highs and lows of the day and weeks that the trend or trend range are established. All right, I'll explain that later again in the cycle. All right, now there are steps on which we can take, or the market has to take in theory, or also in practicality, which I will explain. Now, these steps need to take place before we start thinking about taking trades. So now I'm going to firstly explain the sessions and what each session represents and what it does or what role it plays in each trading day. All right, firstly we have the Asian session, the blue box. This session starts at 2 in the morning South African time and ends at 8 in the morning South African time. Right, this session is not tradable at all the least it would offer you is 25 pips and the most it would offer you is 50 pips. It will normally consolidate. So as I would usually say to my students, that during the Asian session, do not trade the Asian session. You will most likely get nothing out of it. All right, second session we have is just after the Asian session, we have the London session. Now, this session is not really important for trading, but very important for observation. What the market will do in the Asian session is that it will set high and lows of the day or of the week. That is what this session will do. Now, the London session starts exactly at 9 in the morning South African time and ends exactly at 3 in the afternoon South African time. It is a tradable session, but in my experience, I wouldn't say that I've had too many setups that have been formed in the London session and they have paid to a substantial amount. But lastly, we have our biggest session, our tradable session. We have the New York session, the red box. This is our biggest trading session because in this session, when this session kicks in, we are most likely to have a few confirmations already as to where we are going to be trading for the day, or not really for the day, mostly for the day and in line with the cycle. All right. Let's take a look. Now, in theory, this is what it says. The process in theory. At the beginning of the day, the market will start in consolidation in the blue box, Asian range, right? The market will then use the London session to break either high or low of the Asian range, blue box, thus issuing us with the break above the Asian range or a break below the Asian range. This is how the high and the low of the day will be set. Now we wait for patterns. What do I mean by patterns? Patterns, I'm talking about W's, I'm talking about M's or head and shoulders or its inverse. These patterns will usually form from the high or low of the day. Now, a typical scenario of what it could look like, or what it does look like. This is a typical textbook example. All right, scenario says the day starts and London session starts. The market breaks above the Asian range, as you can see in the picture below. Now, a break above the Asian range would mean that you would be a seller in New York session with the presentation of the M formation or head and shoulders. The point is to trade off the high of the day, depending on where you are in the week, of course. If maybe the high of the week has been set, then you're most probably going to be trading from the high of the current day or the high of the current week. This is just how it would look like in a nutshell. Second slide, vice versa. When the market breaks below the Asian range, you should expect to be a buyer in the New York session. The market will break low and present the W formation or the inverse head and shoulders. That would be an indication for you to buy. Again, very important. The point is to trade off the low of the day or the week, as seen in the picture below. As you can see in the picture below, the blue box, you can see clearly London taking it further down below the blue box, and you can see the W forming out in the New York session. And you can see the big impulses, big bullish impulses to the top after the W has been formed just after the session ends. So to show you guys exactly how it looks like, I'm gonna be on my MetaTrader 4. I don't like teaching from TradingView, where it does not really offer the same view as I'm trying to present. All right, so you will notice that I have started and I've marked my weeks off with vertical lines. All right, this is a 4-hourly time frame. Each separator is a week long. And now if I go to my 15, each day separator would represent a day. Now if I zoom out, you will notice that the solid blue lines would mark the end and start of each week. Now I want you guys to grab this concept. This is on a 15-minute. We follow the weekly cycle. All right, so plain and simple, blue box. Now we have the beginning of the day, blue box, Asian session starting at 2 in the morning. Now at exactly 9 a.m. we got that break above the Asian range. The minute price pushed above this Asian range, this would be confirmed as the break above. Now notice, already the market has broken above, sold, came back, gave us a shoulder for us to trade off in New York session. This would be the seller. Remember guys, I told you, if the market breaks above the Asian range, you are a seller for the day in New York session. Alright, so now market breaks above the Asian range, closes on top, sells. This is the M formation, by the way guys. Here it is right here. Here's the M formation right here guys. Right here. This big one here coinciding with Asia and London, but the trade was taken in New York, and look at the volatility that follows it. This is why we trade New York session. The next day, market again breaks above the Asian range, different type of scenario, breaks above the Asian range. Now when that happens already, you should understand that you are most probably going to be selling even further down. Right, so now market breaks above, they go down, hit the Asian low, go back up. So now come New York, they've established a new high of the day, testing a liquidity level or a sensitive area. This is the sell. Again, I'll show you now how it coincides with trends. This is the sell until tomorrow afternoon, New York open. This is the Tuesday, Wednesday, Thursday. Let's go to Thursday. Now on Thursday, blue box, market breaks below the Asian range, gives us the head and shoulders, This was the buy signal here. Around these points here was the buy signal here. We got the head and shoulders in this segment. We got the head and shoulders presented to us in this segment over here. Shoulder, head, shoulder. This is what brought on the buys going into Friday and the week. So already in 1 week you've taken 1, 2, 3 trades, 2 going one direction, 1 going the other. This is what I mean with the market cycle. Market must go down and up in a week, or must go up or down in a week. That is literally the cycle. That's how it works. By respecting this session rule, there is no way you could lack profitability. How does everything now coincide with trends? This is how. Already we have this break above towards the resistance, and basic 2.0 knowledge says we sell from the resistance, we buy from the support. On Thursday, market broke low towards the support, gave us the head and shoulders, and we bought out of this trend, and the next day on Friday we got that retest, and this is how it would end for the week. Alright, I hope you guys understand this. This happens on every pair. Alright, some advice and some tips. Guys, the key to actually mastering this strategy, this day trading strategy, is to be patient. Time is your best friend. You should be patient and wait for the trade to come to you, because it is. Look to take profit at the end of the day. Also, understand that days are different and you won't always get the big movements in the New York session. Another trade tip, if you are going to trade, your stop loss should be at least 25 to 30 pips below or above the high or low of the day, depending on the pair. What do I mean by that? Let's take a look again. So again, let's say you take this trade up here, this one, right? Based on the resistance hit and the break above the Asian range from this high, depending on the pair, since it's GBP USD, a quite volatile pair, we'd go 30 pips up for stop loss. All right. Now, if you are on a rather not so volatile pair, let's take Euro USD for instance. It doesn't move much, but you can see that it reacts quite similarly. Blue box, break above the Asian range, here's the M, and here's the shoulder coinciding with the Asian high. There's the seller. This is what I'm talking about, guys. We need not overthink the process of the market because it almost literally does the same thing every day. Now look at this Tuesday. Remember I had said I had marked out the beginning of every week, which is this blue line. So this would mean this is a Monday, a no trading day for me, and soon for you as well, because there is a simple trading plan that you can follow. Alright, Tuesday, blue box. Market breaks below the Asian range, issues us the W, shoots up, and gives us the shoulder coinciding with the Asian range or the Asian low for the buy. You take this, close up here, call it a day. The next day on Wednesday, blue box, they break below the Asian range, see how they give the W in London, push up and push further down. This is one of the reasons why I say we could or could not trade London session. They give us the W in London, they wait for New York. Now you trade the New York session. They give us the first leg, low of the day, and just after the session they give us that second low of the day. There's the W there, and hence why we got this big upward momentum from EURUSD on that Wednesday. It ran all the way through Thursday, and we finally got reverse signals on the Friday. That is a typical week. How? Again, explaining how trends will play a part. This is how trends will play a part. Already, this is our breakout. This is our retest. Our retest came based on the break above the Asian range towards our support turn resistance. We got the M coinciding with the shoulder of the Asian range. That's the seller, my friend. Do not doubt it one bit. It works. This is you being entirely focused on a 15-minute time frame. Trade the cycle and the week. We cannot be consistently worried about what's happening on a bigger time frame, our technical time frames. All right. So guys, without further ado, let me introduce you guys to your possible trading plan. All right, but first let's finish the tips. Now, like I said, stop loss is 25 to 30 pips above or below the high or low of the day, depending on the pair. Now, again, tip 5 says, wait for the market to break above or below the Asian range. 6, number important. If there's no break above or below the Asian range, there is no trade. Let it go. At least wait for something, either a break above or below. Let it go into the next day. It's okay. At least you didn't lose any money. But what's bad is that you didn't make any money. But that's okay. Not making any is better than losing something. All right. Now, the simple trading plan. And I'm gonna finish this trading plan with a bit of backtesting from the MetaTrader 4 platform with the sessions installed. All right. So guys, simple trading plan. Number 1, no trading on a Monday. Why? We need the market to finish whatever it's been doing for the past week or for the past previous 3 days. Which means if according to the cycle, if a move or a reversal move started the previous week on a Thursday, then it will most likely have to finish those moves on the Monday. So it can be quite a difficult trade to catch. All right. Now, number 2, do not trade the Asian session. We spoke about this. The Asian session is a consolidation session. This session cannot be traded under any circumstances. You need to sleep, or if you can't sleep, at least analyze, do something. All right. Number 3, wait for the market to break above or below the Asian range. If the market breaks above the Asian range, expect the M formation or the head and shoulders and go for the sell. If the market breaks below the Asian range, expect the W formation and go for the buy. obviously with the 30 pip, the 25 pip stop loss. Now, number 4, trade New York session no matter what you see. Sit on your hands until New York session. What do I mean by sit on your hands? Do not trade. Do not trade Asian session. Do not trade London session. And keep all entries taken on the 15-minute. Now, let's do a bit of backtesting so you guys can see exactly what I'm talking about. Let's pick a different pair. Let's take GBP NZD. Let's take GBP NZD. Alright, so I'm gonna zoom out so we can see exactly, and also you can also turn this into a lesson how to backtest as well. Alright, so as you can see, I marked out the beginning and end of every week, and we're gonna start backtesting from every Tuesday. I want you guys to see this. Alright, starting on this Tuesday, the 6th of July. So Tuesday, 6th of July 2021, GBP NZD. This happens on every pair, just different variations. Alright, so we got the blue box, we got our consolidation, we got the break below the Asian range. This could be a possible shoulder. Market then breaks lower, setting a new low of the day, gives us the W exactly in the New York Open. This is where the entry had to be, right here, to take the buy based on the break below the Asian range towards the support. A double bottom, or W as I like to call it, formed on the support, taking New York session. And look at that. Market will then come back and consolidate to end the day, consolidate to begin the day, break low once more in London, give the W, break lower towards the support again, and give the W in New York session. Basically, the W, or the pattern presented in New York session, I always regard as the real one. If it happens in New York session, then it's real. That's how I've come to piece things together for myself. Alright, again, we gave you that beautiful W on Wednesday. You take it again on Wednesday, take it all the way through Friday, Asian session, and the week. And the week on the Friday. As you can see again on the Friday, they broke low again, establishing a low of the day, gave us the W, and there was the buy going into the Monday. You can close on that Monday as well and take a day off. Alright, so that's basically how you would go about trading every single week. Now here's another good example. On Tuesday, this is the Monday, on Tuesday, break above, they extend the break. This is where the sell came from. So now, if you didn't know, that would be the head, this would be the shoulder, this would be the other shoulder coinciding with the next shoulder coming into the next day Asian session. We sold up here. It did this to end the day, and then it sold during Asian session. Days are not the same. You would close at the beginning of the next day. Now, a good example on the Wednesday. On the Wednesday, there is no break above or below the Asian range. Why? Because there was no consolidation in the Asian range. No consolidation in the Asian range, it means it has to come somewhere else. In this instance, they did it in New York session. No trading day. Makes sense. The next day, the Thursday, market, beautiful setup. Market breaks above the Asian range, gave us the M, or if you can see a head and shoulders there, gave us the M or the head and shoulders, sold quite slowly going to the next day Asian, and this is where you ended up the next day, ending the Friday at the lowest point of the week. We took exactly 1-2 trades. Alright, the point is to maximize profit at exit points and becoming greater at taking entries and knowing why you should take these entries. Alright, so that was GBP NZD. This happens on all pairs: gold, GBP USD, GBP JPY, you name it. Any exotic as well, it happens. You just need to wait for the pattern to form out in New York session, and then you will know exactly where you're going. Alright guys, without further ado, that is the FS Gold day trading currency strategy for you guys. This is FS Gold, your mentor, signing out.
Hi there everyone, this is FS Gold, your mentor. So today guys, I'll be teaching you a lesson on FS Gold backtesting approach. Why is this important? I'll be teaching you guys on how to backtest because it's important for you guys to basically know how to practice our strategy for you guys to be able to actually achieve the 90 to 95% accuracy rate that we have on the market. Okay, so without any further waste of time guys, let's get down to it. Firstly, we'll be starting with types of backtesting. Your trading strategy might not work the way you imagined, and it can turn out that the strategy is not profitable at all. To avoid learning this the hard way by losing your account, you have to backtest your trading strategy to get a picture of how it performs in various market conditions. This is where we come to a concept of backtesting. Okay guys, so basically to be able to see whether our strategy will or will not work for you, you're going to have to practice it by back testing. So this is how to basically know how to practice our strategies after you go out through our courses. Okay, so now let's continue. The two types of back testing. There are two ways to perform a back test of your strategy. Number one is an automated back testing, also known as EAs or robots. And then the second one is manual backtesting. Manual backtesting is when you're going to do the backtesting yourself. Okay, so now let me start by explaining what do I mean by the automated backtesting. So the automated backtesting involves creating a program that automatically opens and closes trades for you. These programs, such as expert advisors, also known as EAs, usually based on a technical algorithm, and will open and manage the trades for you when certain technical conditions are met. It's basically, guys, when you have a robot. When you have a robot will do the backtesting for you, hence it will only apply the strategy for you. You won't have to do anything. This way of trading involves creating or buying the program itself, which can be either time-consuming or expensive. Okay guys, so basically for EAs, it's either you can be able to do an EA yourself, or you can either purchase it. It would be time consuming if you're going to make it yourself, and it's going to be very expensive if you're going to buy it. So it also doesn't add to your trading experience. I don't recommend this way if you are serious in becoming a successful trader. You need to feel the market in order for you to become experienced. That is why we will focus on manual back testing. Okay guys, so basically guys, the importance of us teaching you how to manual back test will teach you on how to build experience for yourself. If you buy an EA, don't call yourself a professional trader because you don't know how to trade, but your EA knows how to trade. Manual back testing, a forex strategy. Manual backtesting is when you manually scroll the chart on your trading platform to a previous period and then manually go forward bar by bar with the forward arrow on your keyboard. Doesn't sound exciting, right? Well, this is the best way to see how your strategy will perform in various market conditions and where it needs improvement. Okay guys, let's continue with the slide. There are 4 steps when manual backtesting a trading strategy. So basically here guys, I'll be giving you 4 ways on how to go about doing your manual backtesting of the strategies that we have given you. Okay, so step 1. Open the chart of a currency pair or Nasdaq if you are trading indices on which you want to backtest your strategy, and scroll the chart to a previous period. Make sure that all setups and other tools that are part of your strategy are applied to the chart. Okay guys, so firstly, you're going to open your chart. It's either going to trade in Nasdaq or you're trading currencies. You're going to open your chart, scroll back to the previous part of your chart, and make sure that you're going to start applying the setups. We'll be teaching you guys on how to apply the setups on the next video. This video is just only the theory part. The practical part comes on part 2 of this lesson. So let's move on. Step 2. move to the chart bar by bar and spot possible trade setups. So basically here now, guys, you'll be moving bar by bar. You'll be moving basically from candlestick to another candlestick and spotting on which trade are we in, which setups are we in. And don't worry about me just saying right now. I'll be showing you guys after we finish this lesson. I'll show you the practicality of how to do this. Now I'm just only explaining the steps of what is needed for you to be able to manual backtest our trading strategies. Okay, so let's continue with the lesson. Step 3. Now that you have found a trade setup based on your trading strategy, you will need to write down the trading results of the imaginary trade that you've taken. And then you can do this with a simple Excel spreadsheet, or for those who don't have PCs or basically anything that can open Excel, you can just write it down. Let me continue. This is where you enter the date, entry point, stop loss, take profit, reward to risk ratio, or any other information you think might be of interest to you. Here is the final step, step 4. In this step, guys, you'll repeat the process until you find a possible trade setup again. And after that, guys, we should go back to step 3. You basically now have to go back to see on how to write your entry points, the date, the take profit, the stop loss, the reward to risk ratio, and everything like that. That is the step that you'll have to repeat after you finish the process of spotting your setups. So let's continue. Manual backtesting can be time consuming, but it's the best way to feel how your trading strategy would work in various market conditions. It's important for you guys to know on how to use our strategy. We have choppy markets, we have normal markets, which are the markets that will be able for you guys to trade. And for you to know on whether to spot choppy markets, you have to now learn how to backtest to be able to understand when a choppy market is approaching, for you to just lay off the market, and once the normal market comes back, we continue trading. So know that, guys, when you trade, there will be on and off times, okay? Anyways, let's continue with the lesson. If you backtest on a daily chart, 10 years of data has around 2.5 to 3,000 candlesticks or bars, and it's perfectly possible to go through all of them in a few hours of work. Exactly what I said, guys. It won't take too much time. It sounds like a lot of work, but if you're determined and you're serious, this won't seem as a lot of work. So let's continue. Don't be afraid of the amount of data, as backtesting your strategy is the most important point before you start using your strategy in the real trading. Exactly, guys. It's important for you guys to backtest, to create data, to understand on how to apply our strategy, guys. If I'm showing you a strategy, it can only work best for you if you practice it to its fullest capabilities, okay? So let's continue with the lesson. What is the definition of backtesting? Backtesting is a key component of effective trading system development. It is accomplished by reconstructing trades with historical data that would have occurred in the past using rules defined by a given strategy. The result offers statistics to measure the effectiveness of the strategy. The underlying theory is that any strategy that worked well in the past is likely to work well in the future, and vice versa, guys. If you want to use our strategy to its fullest capabilities, you have to go back and practice it on where we have already practiced to see on how to properly use our trading strategies, okay? So any strategy that performed poorly in the past is likely to perform poorly in the future as well. Exactly, guys. Let's continue with the slide. Now, you're wondering, why is backtesting important? Okay, 3 goals of backtesting. This is the reasons why you need to learn on how to backtest. Number 1, strategic insight. Firstly, you will identify how suitable the trading system is for you. This does not mean you are discovering whether the trading system is profitable, but rather you are examining the fit between you, the trader, and the rules of your trading strategy. The main benefit of Forex backtesting is that traders can determine whether their chosen strategies will deliver the expected results. Hence, we give people different types of strategies. We are all different mentors. Maybe if I particularly, my strategy won't work for you, maybe the other partner or the other member of the FX Gold strategy will most basically suit well for you. This is for you now to understand which strategy works well with you. So now let's continue. Practice. You will learn to trust your trading system and learn to let go of your trades. You may trade in a more relaxed manner once you have taken thousands of trades over years of market data. Exactly, guys. It's important for you to be able to understand on how the market works, and for you to be able to do that is for you to practice, and for you to practice is to backtest. Let's continue. The confidence gained by trading your system repeatedly will show up in the form of a relaxed approach to your live trading. Exactly what I said, guys. The more you practice, the more your results of your live trading will show us. Okay, backtesting can help traders spot trading opportunities by looking at the past price movements and recurring patterns. In other words, it helps traders develop their technical analysis skills. Do you see, guys? It's important to backtest. It will give you a strategic insight on how to properly use the strategy. And number two, you're going to practice this over and over again until it becomes second nature. You will no longer be fearful from the market because you'll be understanding on how it works and when it's time for you to trade. Let's continue. Here is the last tip: confidence. Exactly what I just talked about. You will gain expertise with your trading system. This may only happen if you take many trades, and backtesting is a quick way to accumulate many trades. The reason is a quick way, it's because you'll be going back to the past and backtesting our strategies, hence will allow you to accumulate many trades while you'll be still generalizing the trades on the stop loss, the date, the TP, and the setup applied, and the risk to reward ratio. A close look at each of these three goals may help you to get the most out of your backtest. Forex backtesting is a good way to build confidence. As traders gain experience by testing traders on past price information, this helps build their confidence for when they start trading for real. As you can see, guys, it's very cardinal and important and crucial for you to know how to backtest. It will give you guys a market insight. It will give you practice. It will give you confidence in the market. You'll be able to be an experienced trader who's able to understand which strategy to use when and have confidence in the market when it comes to your live trading. Understand, guys, for you to be able to separate or detach your emotions from trading is that you have to learn to be confident. You have to know that once you see a buy, you have your TP, your stop loss, your entry, you are away from the market. You're only going to see on how your trades run. And for you to get there is that you need to go through experience. You cannot and you will not cheat experience, guys. Do know that the more you practice, the more you'll get better. And understand, we'll be giving you mentorship, and we'll also be helping you along the way on how to actually get to your successful point. Anyways, guys, that's it for your mentor, FS Goat, signing out. So,
hi there, everyone, and this is FS Goat, your mentor. Welcome to the practical side of back testing. So, guys, we're gonna be looking at how do we actually back test using TradingView. TradingView has the best platform, especially a tool that helps you to take prices back and literally back test your strategy to see if it works. So in this instance, you guys need to most definitely subscribe with TradingView Pro package. The link will be below and it will be given in the course. So you guys need to follow it and then register with TradingView, subscribe for either monthly subscriptions, or you can have a choice to subscribe for annual subscription, which comes with a discount. So without any further waste of time, guys, let's get to it. Okay, guys, there's a tool that is called a bar replay. A bar replay is represented by TradingView to help people back test on what happened on the previous datas without being distracted by the future prices. So what literally happens is that, guys, you need to note down that this is very crucial and important to subscribe, because you can only get an access to this replay tool only when you have subscribed with TradingView Pro package. Pro package is very cheap, guys. It's most definitely $14 per month, and it has a discount for annual. Most probably it's like $250. I'm not quite sure about it, but you can go look at it and then you're gonna be able to subscribe. So how do we backtest using TradingView? So number one, guys, let me just explain this bar tool. So this bar tool, as you can see, the minute you click on it, you can literally select each price. Let me just say 26 June 2019. If you click right there, it automatically starts prices from 26 June 2019. And then the prices that happened after the 26th of June 2019, they actually disappear to help you able to forecast on what's going to happen next. For an instance, let me just put in this trend line right here and then just put it right there. We could see that that is a breakout. We could see that it is a breakout, and then we just say that we're going to go long on this position. Right, I'm just making an example, guys. Let's just say we're going to be going long on this position. Remember, this is a daily time frame. I'm just playing around the tools to make you understand how it works. And then let me just say I'm going to hold these prices up until here. And then on the other side, we have the forward, play, and jump to. Jump to is actually, for instance, if you can make a mistake about choosing a price, you can just click here and then you're going to be able to select a different price level again. You can see that. And then when you play, this is forward. Forward means you are able to play prices at your own pace. You just click. Continuously as you click, the prices keep respecting. Continuously as you click, the prices keep respecting, as you can see. Continuously. But if you want to be that person who wants to see prices work, you just come here and then click play, and then you leave everything. Automatically prices play on their own, right? As you can see, it plays well. You pause. After pausing, you tweak or you bring a change into your analysis to see what's happening that is different, right? To see what's happening that is different, and then you play it forward, or maybe you play it and relax to just see what's going on. As you can see, it continuously respects structures and levels. As you can see, continuously respect structures and levels. So that is how, guys, you use the TradingView replay button. So that was the tutorial of how to use it. Now let's jump into how to backtest. Let's get to it. All right, guys and girls, we're gonna be backtesting on GBP USD. So how do you firstly backtest? There is a trend that is called the vertical line. The vertical line is the one we use to determine where we're gonna start backtesting and where we're gonna end backtesting. So let me just put this in an example. Let me just click on it and then just say, let me see. I want to start backtesting from the, let's see, from the 30th of May 2019. Yeah, the 30th right here. And then I want to end backtesting on the 1st of July. Right there. So if you bring prices closer, you're going to see we're going to start from here and then we're going to end from here. And then normally to pull a call out, we like reminding ourselves that this is what the end of back testing. Then you click on it, okay. From there we just put it right there. So we know that if the prices reaches this level, we are done back testing. So now let's get to it. We click where? The replay button. When we click the replay button, we go straight on the 30th of May where we have highlighted where we're starting. You go right there. It automatically erases the prices that happened after the 30th of May. But we all know that we have set this. Let's just lock it for it. We have locked it so you can't move it anymore. You can see even if we click on it, you can't. So let's check on it. So we're gonna drop it to a 4-hour time frame. If you drop it in a 4-hour time frame, you're gonna see the duration, like the time, the difference that we're gonna be back testing is from here up until this current level, right? And then this is what's gonna happen from 1 hour. that is when then our back testing starts. For an instance, I would say most probably this was a double bottom top formation, and then this is a trend. This is a trend from a double top type formation, a descending channel, and then we would know that, okay, most probably from here we can put our buy stop over there. We can put our buy stop over there. This is actually back testing your strategy if it works best for you or what. And then we take prices further to that point, and then we start playing prices now, bit slow, a bit slow, bit slow, bit slow, bit slow. Okay, it wasn't respected. That's when we trigger our levels. We say, so we weren't triggered at that current level, so let's put prices over here and also put prices over there, and then we're going to evolve our buy stop to this current level to see if this is a fake out or it's a price level that is respected. Right, let's play it further. As we play it further, now we can see that the price has literally respected this, but it actually trapped people on the wrong side of the market. And then as we played further, now we are triggered in. So as we are triggered in, are we triggered in impulsively or correctively? It's correctively. So high chances are prices might want to play around in this level, shoot down before actually going up. So that is what we actually anticipating. So let's play prices further. As you can see, it literally did what I actually thought it would do. You see, I said you've got to shoot up, come down, and then go up again. So now we are triggered in. Now let's leave prices to play. As prices play further, they keep on pushing, they keep on pushing, they keep on pushing. Now we stop. From pausing, we take our stop loss from here, we put it on break even, and then we put in our stop loss on break even, and then we start playing prices further to see what actually worked. And then from this current moment, it paid. It actually literally paid, right? What is it that you do? You write everything down. So there are people who prefer writing everything down on paper, and then people who prefer writing everything down on Word documents or something like that, or typing in. This is when you write down that, okay, the descending channel of a double top formation, it is the one that literally worked for me, which means a descending channels also work part of your entry urges, right? These will be your entry urges because they normally respect your setup, right? As you can see, after a descending channel, they literally push up and they respect it. As you can see right here, we're literally pushing nicely to the upside. And then we already put our stop loss on break even, and we're going to tweak prices to at least put it again on, you're going to tweak prices, put it on somewhere about here so that we can secure a little bit of profit. So you can see we have secured so much profit. So let's play prices further. Let's play prices further. Now we are triggered out. As we are triggered out with 32 pips. It's not really bad, especially, right? Now we can see it's time to look at what's happening right now. You erase everything. After erasing everything, that is when you take your paintbrush, right? You take your rubber, you remove everything because you are done with that price level already. The first trade you took, you profited from it, right? Now it's time to see what's happening right now. So you can see prices pushed to the upside, and then they created an ascending channel. After creating an ascending channel, also there's this kind of double top type formation right here. So there's high probability that prices would want to break down to this level and then literally to just sell for quite some short-term thing. So let's see how it works. We played further, we are in triggered in, now it's shot back on. So now it's time to tweak our levels. So what we do, we push prices to this level, cater for that level also, because this is called evolving. From seeing this, there's high probability that prices would, once they break out to the upside of this level, once they break out the upside of this level from here to up, they're gonna buy. Once they break out to this, to the downside, they're gonna sell. So what do? We wait and become patient, right? As we wait and become patient, we played further. Played further, played further, played further. It's respect, it respect, it respect. So there is no clear direction so far because it continuously plays within this price level we have set for it, right? So what do? We played further. We played further. Now it dropped and we were late to even see the opportunity, right? As you can see, we said if it breaks below, it's a sell, but if it breaks above, it's a buy. So we continuously played further, played further, played further. We're looking for another opportunities to enter, guys. Remember, just because you missed one trade, that doesn't mean that you're gonna miss all trades. It's just, it happens sometimes to miss one of those high probabilities that you have set for yourself, right? And then you continuously do so. You continuously do so, you continuously do so, and then you start looking at the markets and say, okay, so this area was previously respected, so there's high probability that it might be respected again, right? And then we check on what's happening right now. This might be a repeatance of a structure. This might be a repeat of a structure, as you can see. So we would know that most probably if we break below, we're going to be looking for short positioning, right? We're going to be looking for short positioning. So let's play it further. Now we are triggered in. As you can see, we are triggered in. Remember, this is the second trade. After it has triggered you in, guys, you literally write it down. You can either write it down on your app, take a screenshot, paste it on the app, and then write what did you see, how did you see it, and or maybe you can write on the book. Some people prefer practical writing. You can see you saw a double top type formation, and then with the respect of an ascending channel, and then the price literally broke down impulsively, corrected to the sideways, giving us an entry urge that we're going to be looking for some quite different opportunities, and then we literally capitalize from it. So we are triggered out of the trade. Remember, some trades will take you out of break even, some you would profit from it, some will take you from profit secured. Some will literally hit your stop loss. It's possible. This is the market, guys. We don't control it, but what do? We follow it. So let's play prices further. Let's play prices further. So if prices go further, you can see they literally dropped. Our direction was right, but it's just that maybe we had an early entry. That's why we were triggered out of break even. But it literally, our direction was right. What do we do next? We erase. Once you erase, you want to see, because the main focal point is to focus on price action, nothing more. So what we're going to look at, we're going to see how do prices react when they reach that lower zone. Are they correcting or are they impulsing? So as you can see, they start correcting. They start correcting. They start correcting. They finally broke out, right? When they finally break out, what is it telling us? We go back to the bigger picture. What does the bigger picture have for us, right? So go back to the bigger picture. What does the bigger picture have for us? The bigger picture is telling me that, okay, so it was respected previously. So this is an area of sensitivity. That is why the price is literally turned on that level. So we go back to the 1 hour time frame. We look for something that's quite different, right? So go back to the 1 hour time frame. We start reading in between the line. We played further. So we played further. We want to see what the prices are doing. So price literally gave us something that is when we can cater for it from like this current level. And then also here. So what would we anticipate? We would anticipate that most probably buying opportunities are coming very soon, right? Buying opportunities are coming very soon. That is when we played more further. So we played a bit more further. Now buying opportunities have kicked in. Imagine if we literally saw this exhaustion, we could have capitalized from this current level to that point. But the most important thing is to take the best trades. So we played further. It keeps on pushing. It keeps on pushing. It keeps on pushing. It finally reached the top. It keeps on pushing, creating a double top type formation over here, a mini double top. So that mini double top literally pushed down and then it was respected. Remember, this is our exit urge. We know once the price reached this level, we are done backtesting for the month of in between 30th May 2019 to the 30th of June. Yeah, the 30th of June. So you play prices further, So if you look at it, prices are still respected over there, right? If you look at it, that's how we play around. That's how I play around. We keep on looking. We only took two trades on this pair this month. So this is how you know that a certain pair respects your setups. So it finally broke out. But look at the overall. The overall is saying this might be a double bottom type formation right here. So once the prices have broken above, what do we anticipate? Anticipate continuations of buying opportunities, isn't it? So most probably would say if it breaks above, we're looking for buying opportunities. What do? We play prices further. So it broke down, didn't break to the upside. So what happens? We cater for what's happening right now. So the prices have been ranging quite good on the in between this consolidation channel. So we'd also anticipate that prices will continuously push to the downside from here to respect that area. From here to here. So we play prices further. We're intrigued, so we are still safe. So we tweak our prices and say, okay, cool, maybe this is what's happening. We cater from here. We also cater for there. And then we evolve our structure to here. And then prices play further. As prices play further, we tweak again. Remember, this is our levels. We tweak again. So now it finally broke out of its comfort zone. So we'd also say we are still at the right position. Played further. We are not triggered, guys. It continuously plays. So what is it that it's creating? It's creating an expanding channel right now. It's telling us a different story. It's creating a bigger version of a pattern. So we wait a bit. But waiting, we have finally reached our level of backtesting, which is the 30th of May. The 30th of May. So the 30th of May will be the day we end. So we ended here. And then remember one thing. From here to here, there was no loss. It was only take profits. It was only profiting from it. So this was a good month for trading GBPUSD. It respects our setups. That means it's one of the pairs that we always need to trade. So that is how, guys, you use backtesting on TradingView, especially also on currency pairs. That is how it works out. So you can use this tool the same way as I used it on different pairs. You can use it on USD CAD, on GBP CAD, every tool or every pair you can use. This is gonna fit. You're just gonna know you're backtesting from which month to which month. And then that's it for me. That's all for the FX Coach Your Mentor, guys. Nonetheless, this is FX Coach Your Mentor. I'm signing out.
Ladies and gentlemen, I greet you all. I'd like to take this opportunity to greet you all and welcome you to yet another additional lesson that we have put. We've been getting a lot of questions that ask us, how do pair correlation works? Because sometimes it's much more easier for you to trade when you know if this trade is behaving this way. So this means that I should behave this way, or this means that I should actually expect such from this certain other pair. So that's how pair correlation works in a nutshell. So this is the beginning of the lesson. So let me not waste any further time and just get into it. So the topic is trading currency correlations. So every time when we always start, we always ask, what are currency correlations, or what is the meaning of the main subject matter that we are going to be discussing at that particular moment in time. So in a simplest way, currency correlations or forex correlations are statistical measure of the extent that currency pairs are related in a value and will move together. Positive correlation occurs when two currency pairs go up in the same time, whereas the negative correlation occurs when one appreciates and the other one depreciates. So from this, you already know that we have two types of correlations. It can either be a positive correlation or a negative correlation, and it was explained for you how does each occurs. So moving right along, it's a question that you guys are interested in, which is, where will currency correlation help me as a trader? So now I know that there is currency correlation, but how will it help me as a Forex trader? So this is the answer to that question. So understanding and monitoring the currency correlation is important for traders because it can affect their level of risk when trading in a Forex market. So on this lesson, it will be of utmost importance for us to look at how Forex correlation is determined, how does it affect trades and trading systems, and what tools can be used to track the currency correlations. So it's very important for you to understand the currency correlations because you will know how to risk that particular trade in the Forex trading market. So you'll know whether I should risk more because, for example, let me not give an example now because we're going to examples. So you will know whether I should risk more or risk less on a trade because you know if that particular pair is in a positive correlation with the other, you know, okay, for now I can do what if both trades are buying, I know I can risk more at that particular moment in time. So moving right along is the examples. So these are the examples of currency pairs that can be correlated. So we will start with the pairs that are positively correlated. So for example, GBP USD and Euro USD. Both of those pairs can be seen as positively correlated. And then the person asks me, why are you saying so? Euro USD and GBP USD, they both contain a USD as a common factor. That's the first thing. The cherry on top of the cake about these pairs is that the Eurozone and the Great Britain are closely tied economies which are trading together. So these factors are the core reasons why these pairs can be seen and be viewed as correlated. So the other example that can be given is the one of Audi USD and NZD USD. So same as with the Euro USD and the GBP USD, Audi USD and NZD USD both contain the USD as a common denominator or as a common factor, and both are from a closely tied economies which trades together in Australia. There's Australia that is a continent, and Australia has a country that is called Australia as well, which also has within it a country that is called New Zealand. So they are very much closely tied to each other. So moving right along, we're going to go to the second example now. Pairs that are negatively correlated. Currency pairs that are non-correlated move independent to each other. This generally happens when the currencies in two separate pairs are completely different or from different economies respectively. So moving right along, I'm going to be giving you the examples of the pairs that are negatively correlated. For example, it's Euro GBP and GBP NZD. Euro GBP and GBP NZD, these currency pairs or these two currency pairs are non-correlated as they do not include any common currency or which any common currency in between them, and it's four separate economies. So and then they form part of the four separate economies, which is the Eurozone, the US, the UK, as well as the New Zealand. This means there is a good chance that if one grows, there is no correlation for the other one to grow too, which means that if the other one grows, the other one doesn't grow, or if the other one buys, the other one moves in a completely different direction. So this is the continuation. So other pairs that can be seen as negatively correlated are Euro USD and Euro Audi, Audi USD and GBP Audi, XAU USD and USD JPY, Euro GBP or GBP USD and GBP JPY. So those are the pairs that can be seen and be viewed as negatively correlated. You have your percentages there, which shows you how these pairs can be seen as sometimes negatively correlated. So you have Euro USD and USD CHF. We have GB, which is correlated like 91%. We have GBP USD and USD CAD, which is 88% correlated. We have GBP USD and USD CHF, which is 93% correlated, but negatively, not positively. Don't get it wrong. So moving right along, Forex traders will use currency correlations to either hedge their trades, increase their risk, or to use it for creating value via commodity correlations. There are various ways to trade currency correlations, of which can be used then. So traders will use a currency correlation to potentially increase their profits. For example, since GBP USD and Euro USD are positively correlated, a trader might place a long trade for both to utilize the relationship that is there and available for both. But we do also have advantages and disadvantages of pair correlations. So advantages of this, that it can potentially increase returns over more currency pairs. So this means what? This means that if you already know that GBP USD is gonna buy, you can also buy Euro USD in its support zone and increase your lot size and actually do what and risk more on on Euro USD. That means that it happens that sometimes GBP USD had already moved from its support, it's in the midway, and you go to analyze Euro USD and you find out that Euro USD hasn't moved, it's still in its support structure. So that means I can increase my risk on that particular trade at that time and moment. So we also do have the disadvantages. The disadvantages is also an advantage. You can take more risk, so you can risk more now, but it happens that there are certain small factors that can affect that particular trade and end up not going to your direction. So on the other hand, traders may be more risk advised to opt to use the currency correlation to reduce risk. For example, instead of placing the maximum positions or size on Euro USD, the trade may split 50% on the position on Euro USD, and the other 50% can use it on GBP USD. For example, this is the example. For let's say you use the standard lot, which is lot size 1, on buying Euro USD. You can, instead of using lot size 2 on Euro USD, you can know that, okay, fine, let me divide that the risk and put the other 50% on GBP USD. That means I'll also open the trade with a lot size 1 on GBP USD. So advantage of this, it can potentially reduce the risk by splitting across more economies. The disadvantage is the transaction costs are higher. It happens that sometimes the commission that you may be paying on Euro USD is not the same as the commission that you might be paying on GBP USD to enter the particular trade that you want. So yes, that takes us to the end of our lesson. You're gonna have these slides presented to you. You can also move on to the following lesson. Let us do a small recap so that you can see, but these slides will also be provided for you. This is the first slide, the second, so the final slide. So yeah, you're gonna have this slide presented to you. So for now, you can move to the next lesson. Thank you so much, ladies and gentlemen. Let us move forward.